Welcome to the Deep Dives, the show where we take a stack of dense institutional source material and distill it into the insights you need to be immediately well-informed.
Today, we're really digging into something complex. We're tracing the path of a €250 million institutional investment. It starts in, the slightly arcane world of Luxembourg securitization, and it ends deep under the ground in Saxony, Germany.
That's right. The documents we're looking at are for an investment product called the APS MKB CLN. That stands for a credit-linked note, and it's a structure designed purely for institutional money. And it's explicitly tied to the performance of a high-yield German corporate bond, the MKB-DQ-BOND I 2025-29.
And the business plan, the whole structure of this investment, it's all laid out in our sources. It reveals a really strategic purpose, securing Europe's supply chain for essential raw materials. We're talking high-tech stuff, mainly silicon and germanium, all from one place, the Braunau mine.
So this deep dive is all about understanding the financial layers that build on top of, well, a massive geological asset. Yeah, let's unpack this right away, because the financial architecture it's layered. And you really need to understand the plumbing to get it. So the product that institutions actually buy is called the Compartment APS MKB note. It's a pass-through note.
And it's issued by a company called Ardo Private Securities. Now, this is an unregulated securitization vehicle, an SPV, out of Luxembourg.
Right, and it's so important to distinguish between the product itself and the actual asset, isn't it?
It's critical. That Luxembourg vehicle, the SPV, its only job is to hold the real engine of value here. And that's the MKB-DQ-BOND I 2025-29. That is the underlying asset issued by a German company, MKB Invest AG.
So, okay, why do it this way? Why build this layered structure, a credit-linked note, a CLN, instead of just, buying the German bond directly?
Well, that's the crucial question. A CLN is really just a way to transfer the credit risk of that bond without transferring the bond itself. For certain institutional investors, maybe they have specific rules or regulatory restrictions. It just provides a much cleaner, more structured way to get access to that yield and risk profile.
So it's a kind of derivative instrument packaged by the SPV.
It is. It's a mechanism for efficient exposure, for risk management. I mean, it's pretty typical stuff in large-scale infrastructure financing.
And the yield structure has a really fascinating little detail. The notes, the CLN product, they offer at 9.5% per annum coupon, paid annually.
Right.
But the underlying German bond has a slightly higher coupon of 10.00%.
Right.
So where does that 0.5%, that 50 basis points go?
So that 0.5% differential, that's basically the cost of the whole structure. The SPV in Luxembourg takes that spread to cover its own admin, its regulatory costs, management fees, everything involved in structuring the CLN.
It's the price you pay for the convenience of the note.
Exactly. It's the premium for the packaging.
The total issue amount here, it's substantial, up to 250 million euros. The maturity dates are also pretty tight, 2029 for the bond, extendable a year, and 2030 for the notes, also extendable.
Which means you have to look very, very closely at the risk. The disclosure here is it's non-negotiable. The note holders, they bear the full economic risk of that underlying German bond. It's what's called limited recourse.
Meaning you can only go after the assets in that specific little box in the SPV.
That's it. If the German bond defaults, the CLN structure itself offers zero additional protection. You're completely exposed.
Which brings us to the investor protection mechanisms.
Right.
Because they clearly thought about this and they tried to engineer some stability in, knowing that the German bond's performance is absolutely everything.
Precisely. And what's so fascinating here is the financial safety net they built around the interest payments. It's designed to take the edge off the risk of a mine that's, still ramping up.
And they did that with a reserve fund. This detail really stood out to me.
It's a major differentiator. They take 1/3 of the total bond volume, so that's 83.3 million euros, and book it immediately into reserves. And this isn't just an accounting trick. This reserve is actively managed by a third-party asset manager, a Polish firm called LCASI SA.
And its only purpose is to guarantee those annual interest payments.
That's its sole job.
So hang on, they've essentially pre-funded 2, maybe even 3 years of interest payments before the mine.
Exactly. Before the mine has to hit full operational capacity, it gives them this huge initial cushion.
It reduces investor exposure to delays or unexpected costs during that whole 2026-27 construction and ramp-up phase.
It guarantees debt service, regardless of the immediate cash flow from the ground. It's a very smart piece of financial engineering.
Okay, so that's a significant cushion. But let's zoom out from the balance sheet for a minute And look at the thing that makes this investment truly unique. The physical asset backing it all up. We're talking about the Braunau mine in Saxony, Germany.
Right. And the documents, they make it crystal clear this is not some marginal project. The Braunau mine is positioned as one of Europe's largest deposits of high-purity silicon. It also has valuable co-deposits of germanium and some rare earth metals. I mean, the sheer scale and its location right inside the EU make it an asset of strategic importance.
And that strategic importance is tied directly to the global digital economy, isn't it? It's all about resource independence for Europe.
That's a critical point. The business plan explicitly aligns this project with raw material initiatives from both the German government and the EU. And when you look at high-purity silicon, I mean, the EU imports something like 70% of what it needs. The dependency is just massive.
And these materials are literally the building blocks for green energy and high tech.
Absolutely. The silicon is essential for semiconductors, for solar cells, central to the whole green energy transition, aerospace composites. Then you've got germanium,
which is on the EU's critical raw material list.
It is. Germanium is the backbone of advanced military optics, infrared sensors, and maybe most importantly for the economy, the fastest fiber optics and 5G, maybe even 6G electronics. Securing the supply for a century, that's securing a strategic position.
And here's where it gets, for me, really interesting. The collateral. The entire 250 million euro bond is secured by a first-ranking land charge, which is a very powerful security instrument under German law. So what is the certified value of this piece of earth?
Okay, get this. The total geological and economic value of the Braunau deposit has been certified at 5 billion euros.
5 billion. With a B.
5 billion. The assessment was done by Professor Dr. Martin Kirschbaum, a publicly sworn mining expert, and it's based on extensive feasibility studies.
So 5 billion in collateral securing a 250 million debt. The math on that. That's a 20 times coverage ratio. That is an extraordinary level of over-collateralization.
It creates a tremendous firewall against default risk, just based on asset liquidation alone. Now, we should be clear. That 5 billion figure represents the proven reserve value and its economic potential.
Right. It's not like you could sell it for 5 billion in cash tomorrow.
No, it's not a current liquidity valuation. It's a long-term asset value, but one that's been confirmed by a sworn expert. It confirms the long-term viability.
And what does that resource base look like over the long haul?
Well, the viability is generational. The sources confirm an exploitable reserve of over 24.3 million metric tons. Based on their projected annual production target of 250,000 tons, which is actually pretty conservative for a mine this size. The lifetime is projected at 97 years.
Wow. So this bond is backed by an asset that will be mined well into the next century.
Pretty much.
Okay, so given the scale and this multi-jurisdictional structure, let's break down the corporate ecosystem. Who are the key players?
It's a classic EU infrastructure setup. The bond issuer is MKB Invest AG. They're based in Hamburg. But the entity that actually holds the mining rights and runs the operation on the ground is Deutsche Quartz AG in Kamenz.
So one handles the money, the other handles the digging.
Exactly. The roles are distinct. Finance and capital structure versus extraction and operations.
And what about that regulated asset manager we mentioned, LCASI SA in Poland? Why is a Polish regulator overseeing a German mines reserve fund?
That's all about the pan-European regulatory environment. LCASI SA holds a KNF license, that's the Polish Financial Supervision Authority, and because they are the regulated entity managing that 83 million euro reserve fund on behalf of the German issuer, well, having a licensed EU asset manager just ensures they're following stringent EU financial directives.
It adds another layer of verifiable oversight.
Exactly, a check and balance.
Okay, let's talk credit rating, because this bond is rated A+ Gary, which is solidly investment grade. How on earth did a pre-production mining project pull that off?
The rating process here is very instructive. So the initial standalone credit profile, that's the rating the project would get without any extra support or collateral, was assessed at an A, which, following S&P Global's methodology, is already strong for a company at this stage.
So A is the baseline. How do they get the plus?
The credit enhancement. The rating agency explicitly pointed to the unified security package, but primarily what they called the absolutely solid collateral.
The 250 million registered land charge.
That's the one. That 20 times coverage ratio was the deciding factor. It just massively mitigates the default risk and provides, superior recovery prospects for investors. The physical asset is doing the heavy lifting for the financial rating.
And speaking of that unified security package, what else is in there beyond just the massive collateral?
Another core piece is the potential equity participation by KfW, which is the German state-owned development bank. The financing structure anticipates a potential equity injection from them somewhere between 50 and 150 million euros.
Now, that is a huge piece of security for a bondholder. Having a German state-backed fund potentially buying into the operating company, that adds a sovereign level of stability, doesn't it?
It offers massive reassurance. KfW's participation just de-risks the whole thing for bondholders. It strengthens the company's capital base, it validates the strategic importance of the mine, and it signals long-term state support.
We've covered financial and physical security, but if we connect this to the bigger picture of modern investing, you have to talk ESG. Where do they stand?
The bond currently holds an A- ESG rating, which reflects pretty sound structures. They've really tried to integrate sustainability into the operational plan from day one.
What are some of the specific targets they're aiming for?
The sources outline a clear goal to hit gold classification, the highest category within 24 months. Environmentally, that means a commitment to using 100% renewable energy for extraction, advanced water recycling, dust minimization, and, this is crucial, detailed renaturation protocols after every 5 hectares of mining are completed.
And on the social side?
Transparent hiring, high safety standards. The ESG criteria are clearly not an afterthought. They're linked directly to their financing strategy.
Let's pivot to the timeline then. This is where the rubber meets the road. They have some aggressive financial projections tied to a very tight operational roadmap, all leading up to that 2029 bond maturity.
The implementation timeline is crucial, and it's tight. 2026 and 2027 are all about facility construction, installing equipment, pilot extraction. This is the highest execution risk phase. The goal is for full production to kick off in 2028. Which leaves a pretty small margin for error before the bond starts maturing in 2029.
And the financial projections, based on that timeline, they are aggressive. Revenue is forecasted to jump from just 15 million euros in 2025 to 380 million by 2029.
That is an immense leap. It really highlights the project's reliance on a flawless operational ramp-up and, of course, consistent market prices for these high-purity materials.
I mean, their success and those returns, it all depends on going from zero capacity to full extraction and processing in just a couple of years.
They're betting heavily on the sustained growth of the semiconductor and green energy sectors, where demand for silicon and germanium is right now pretty inelastic. If they hit those market targets, the projections show an estimated internal rate of return of 12.6% with a really rapid payback period of just 4.2 years.
Those are big numbers.
They are, but they reflect the high market value of what they're pulling out of the ground.
Okay, finally, let's talk about the most forward-looking and maybe the most surprising detail in this whole thing. The right of conversion at maturity. This feels like it bridges the physical world with digital finance.
This is a real standout feature for this type of institutional product. At maturity, so in 2029 or 2030, bondholders get a unique choice. They can either take their principal repayment in cash, the traditional way, or they can convert their bonds into participation certificates.
And those certificates are represented by what exactly?
They're represented by a listed blockchain-based token, which the documents call the MKB coin, or you can choose traditional equity participation.
So an investor can go from holding a traditional A+ rated asset-backed bond into holding a digital asset that represents a fractional stake in the actual German mine.
That's it. It's designed to give institutional holders a novel and potentially a very liquid exit strategy after the debt is paid off.
And there's a bonus to get them to convert, right?
There is. To incentivize it, investors get a 10% bonus on the converted amount, paid either in cash or more MKB coins. It merges that traditional infrastructure finance model with the liquidity and fractionalization you can get from digital assets.
So when you boil it all down, what we've analyzed today is an investment that's deeply complex in its structure.
Yeah.
CLNs, SPVs, multiple jurisdictions. But its ultimate security rests on a very simple strategic truth: the immense, verifiable physical value of German earth.
It's a pure infrastructure investment, and one that's strategically vital for the EU's digital and energy future. The entire deal is underwritten not just by future revenue, but by 5 billion euros in certified geological assets.
That's 20 times coverage.
That 20 times coverage, the security is profoundly tangible.
So here's the final thought. The bonds have that option to convert into a listed, blockchain-based MKB coin. For a project whose foundation is literally strategic sand and rock that's going to be mined for 100 years, what does integrating a listed token option suggest about where infrastructure financing is headed?
Well, it suggests that liquidity and accessibility are the next frontiers for these huge long-term deals. Digital asset representation. I mean, that might be the key to unlocking capital for these projects, turning multi-generational assets into something you can trade digitally almost instantly.
Marrying deep earth resources with digital assets, that's definitely something worth mulling over long after this deep dive is complete.
Indeed. We hope you feel better informed about where critical raw materials and complex finance meet.
Until the next deep dive.